This is WealthBT, a podcast of BT correspondents.
An investment-linked insurance plan, or ILP, sounds like it can give you the best of two objectives, protection and investment returns. But how well does it do either one or both? And at what cost? Today's ILPs may be sweetened with some generous payouts of bonus units in the first couple of years and annually as well. Are these units free? Do they put you ahead? How well do you understand how ILPs work? Welcome to WealthBT, a podcast by BT correspondents. I'm your host, Genevieve Cua, Wealth Editor of the Business Times. Every week, my colleagues and I break down a business story that matters. For years, I've avoided writing about ILPs because they have very high costs. But my interest picked up recently because of news that new ILP business in the insurance industry surged by 40% last year. So I started doing some research. I looked into some plans using documents on comparefirst.com. There have been some changes in plan features. My focus in this episode is regular premium ILPs. In the plans I looked at, the protection or death benefit can be very small, only 101 or 105% of your premium. That's also called 101 or 105 plan. It comes closest to a pure investment. The other new feature is generous bonus units paid in the first 2 or 3 years. But the essence of ILPs hasn't changed. They still have high costs and their structure is complicated. So it's still important to be careful what you're buying. There are some misconceptions surrounding ILPs. Here are 5 of the biggest and most concerning. 1. Some salespeople may tell you that an ILP is, quote, capital guaranteed upon death. Have you heard this before? This statement is wrong on many fronts. ILPs have no capital guarantees. The death benefit may be guaranteed. When death occurs, your beneficiaries basically receive the premiums you've paid so far. That's the guaranteed cover, plus the net value of your investment, which is not guaranteed. The cover is net of any withdrawals or loans you may have taken up. But some ILPs don't even guarantee the death benefit. The statement, capital guaranteed upon death, is a way to hook you with the magic phrase, capital guaranteed, which Singaporeans like. If you hear that, please be quick to correct the advisor or representative. The second misconception goes like this. A regular premium ILP is a way to invest regularly to help mitigate the timing risk. That's somewhat true, but it isn't the full picture. A regular premium ILP is like a regular savings plan for any unit trust. By investing the same amount regularly, you use dollar cost averaging to overcome the timing risk. Your premium will buy fewer units when markets are high and more units when markets fall. That sounds logical so far, but it's more complicated in practice. Because in an ILP, the number of units you buy isn't necessarily what you end up with at the end of, say, a year. ILPs have high recurring charges, which are deducted by canceling your units every month. So the number of units you buy is reduced by the costs. The biggest is the annual admin charge. The highest I've seen is almost 4% a year. That's separate from your fund's annual management fee. But your advisor may tell you your ILP will earn welcome units and loyalty units. Does that help with the high costs? To some extent, maybe, but not fully. To complicate things further, some ILPs have dual accounts, which may have different fees. The third misconception is that the bonus units given to you are free. Well, the insurer does pay for the units up front, but the cost is eventually clawed back by those high annual charges. So really, there is no free lunch. Still to come, how adequately are you protected when you get a regular premium ILP?
Money Hacks by the Business Times delivers useful financial tips every Monday. Subscribe to the playlists in Spotify, Apple Podcasts, or wherever you listen to podcasts. But if watching is your thing, we've got you covered. Subscribe to the Money Hacks playlist in the podcast tab of BT's YouTube channel and watch as Howie Lim gets the inside scoop on the best money hacks. Subscribe and watch today.
And now, back to WealthBT, a podcast of BT correspondents.
Welcome back. We've just been discussing the common myths surrounding ILPs. The fourth misconception is the impression you may get that you're sufficiently protected with an ILP. Is that so? At point of sale, you have a policy illustration with returns projected at 4 and 8%. One page shows you the death benefits. The 8% column will look impressive, but most of that total death benefit is not guaranteed. The truth is, you need life protection if you are the main breadwinner, your children are young, and you have loans like a mortgage. You need a guaranteed death benefit you can rely on, regardless of how your investment performs. But in an ILP, guaranteed cover will be very low, mostly just a little bit more than your premiums. The total cover will largely depend on the performance of your fund. But death and markets are unpredictable. If you're counting on an ILP for protection and markets do poorly, your family may end up very vulnerable financially should death occur. The fifth misconception is the expectation that your ILP value would rise in a straight line because that's how it's illustrated. That's far from the case. The illustration mainly shows how your ILP is impacted by costs, like surrender penalties and annual charges. You may ask the salesperson to work out the net rates of return after costs. Based on my own calculations, on the lower gross projection of 4%, the net return can be as little as 2% a year after 20 years. That makes the ILP little better than a fixed deposit because of costs. So what's a sensible approach to regular premium ILPs? I think you need to ask yourself 2 questions. First, do you have enough life cover? Protection is a basic building block of a financial plan. The MAS Basic Financial Planning Guide suggests that you need life cover equivalent to 9 times your annual income, says Money Owl Chief Executive Chunting Weber. She believes that saving and investing through an ILP won't give you sufficient protection because it would take far too long to accumulate enough value that approaches the cover you need, even at a high projected return. Instead, the most cost-effective form of life cover is a term plan with no cash value. You pay a premium and secure a guaranteed death benefit for 10 or 20 years, or as long as you need it. If you're young, you'll find that the annual premium of a term life cover isn't expensive. With that, you have the flexibility to reduce and eventually drop the plan when you no longer need it. The second question is this: are you investing in an ILP mainly for investment returns? If so, consider other options out there. They're far less costly and give you more flexibility. For example, the all-in fees at some robos can be less than 50 basis points a year, and funds' annual management fees are also lower than those you'd find in ILPs. And DAWAS rebates the trail fee back to investors. The trail fee is the portion of the fund management fee paid to distributors. This means on some robos, the fund management fee can be halved. In ILPs, the insurer keeps the trail fee. I'm a big advocate of lower costs because you can't argue with the math. The lower the costs, the greater the return, and that helps you reach your financial goal faster. As I've written in my recent Mind the Gap column, ILPs use a carrot and stick approach. The carrot is the system of bonus units to sweeten it. The stick is the high charges for surrenders or withdrawals to force you to stay invested. But it's very hard to anticipate your cash flow needs far into the future. You may suddenly lose your job or need to raise cash for an emergency. I think by investing regularly just by unit trusts, you'll save a lot in costs, You can simply pause your investment or redeem units when you need to raise cash. I hope this episode clarifies things about ILPs and helps you to ask questions before you jump in. Until the next episode, thank you for listening. BT Correspondents will be back next week with a new episode on transport, so do check it out. If you have any thoughts or questions about the show, email us at btpodcasts@sph.com.sg. I'm Genevieve Cua. As always, thank you for listening.
This is a podcast by the Business Times. Find more BT podcasts at businesstimes.com.sg/podcasts. Or wherever you get your podcasts. This podcast is meant to provide general information only. SPH Media accepts no liability for loss arising from any reliance on the podcast or use of third parties' products and services. Please consult professional advisors for independent advice.